It is time for your community focus, and the feds have raised interest rates by 3/4 of a point on Wednesday. It's the latest, I should say, effort to tame inflation. So here to talk about how that can impact your wallet is financial advisor Jeff Massey. Thanks so much for being with us.
It's a pleasure to be here.
So the big thing on everybody's mind and top of the discussion is this recession, or the potential for a recession, but it's not that easy to actually declare. We don't see that happen fast.
We don't see it happen quickly. The start is, do we have 2 quarters of the gross domestic product that's negative? First quarter was a negative 1.6. Today they announced negative 0.9. Now those numbers can always get adjusted. So the National Economic Bureau that declares the recession, they're very slow to do that. Like in 2020, we had a recession.
Right.
They didn't declare that until July of 2021. So they take their sweet time.
And so what are the factors that they use to determine, yes, we're in a recession, no, we're not there yet?
Well, it starts with the 2 quarters of negative production, but they also look at payroll, they look at industrial sales, they look at retail sales. And it's been interesting with retail sales because it's still very strong. And even though Walmart is reporting that people are buying maybe more off-brand names, generic brands, sales are still fairly strong because they're using their savings that they built up from the stimulus money.
Okay, and that's something I wanted to touch on too, the savings. I mean, right now everything is more expensive. So what's your advice for clients or just people at home? Like, you have to spend money, you need your goods, your necessities. What do you do?
Well, buy what you have to. If budget does become an issue, then look for those generic names because it'll help you save money on a week-by-week basis. But as we're seeing, the grocery inflation rates are up quite a bit more, ironically, than the restaurant inflation rates are. So, interesting.
Right, and when it comes to home buying, if you want to buy a home right now, it's going to cost a lot more. You're even talking about your own numbers that you crunch for your own personal situation. What should people do?
Yeah, if I could just share that.
Yeah.
I got a house at 2.75 interest. It would be in like November of 2020. Now, when the rate was at 5.81, it would be 40% more to buy that same house. That's a lot of money. So what I think that's going to do is put pressure on the selling prices, so people may be able to buy houses at slightly lower rates. That is a possibility. And if you're looking at a long-term stay in your home, then these rates are not likely to stick around forever. So you might have these rates for a year, maybe even 2 years, but then rates should come down and then you have the opportunity to refinance.
So if you find a dream home right now, what's your advice? What would you tell a client?
I would say if you can reasonably afford it in your budget, just go for it if it's a long-term purchase. If you're looking, I want to be in this house for 2 or 3 years, then I would hold off.
And because we are dealing with all these raising prices, interest rates, I mean, the stock market as well, like you said, in the second quarter, it's now dropped, that we learned today. What do you tell those who have investments in those stocks?
If you have been invested right along, I would suggest stay there, because we do feel that we are at or near the bottom. And in bear markets, historically, we have a bear market rally, then another pullback, but not as deep, and then it takes off from there. Some of the best returns in the market are in the early stages of when it flips from a bear market to a bull market. So our team is looking at, we've been in cash for a while, we're looking at moving money back into the market, so we think the market's pretty close to the bottom there.
And when can we expect things to change and get back to a normal level?
Well, what is normal?
Right.
I mean, that's the challenge. We do expect, and we've read many different articles that are saying that by year end, the S&P 500 could be up 15% from where it started the year. I think that's a little optimistic. We expect it to be positive, but I wouldn't be quite that optimistic.
All right, Jeff Massey, financial advisor, thank you so much for joining us at 4 with all your insight.
Always a pleasure.